In this video, I'm going to teach you about 9 accounting principles. And if we're just meeting, I'm Casey, an actual accountant at a Fortune 200 company. So grab those flashcards and a pen because you're going to want to take notes. So I want you to put this acronym into your brain. Every really cool frog grows many mighty muscles. I know it's strange, but it should help you remember. E stands for economic entity. This requires that each economic entity keeps its own set of financial records. For example, Kylie Jenner, she owns Kylie Cosmetics and Kylie Swim. These are 2 separate economic entities, so they both prepare their own balance sheet, income statement, and statement of cash flows. R stands for relevance, reliability, and consistency. This means that businesses stick with the same accounting policies period after period. For example, say Kylie Cosmetics uses the LIFO method to track her inventory. She can't just switch to FIFO the following quarter because it produces a better financial result. It's about fairness and transparency in accounting. C is for cost. Transactions must be recorded at their actual cost. Say, for example, Kylie Cosmetics purchases a truck for business purposes, and the truck is advertised at $105,000, but she only paid $100,000. In Kylie's financial statements, she must record it at $100,000, the actual cost paid for the truck. F is for full disclosure. Businesses must share enough information that's useful for decision makers. For instance, say that you're preparing the 2025 year-end financial statements and you're preparing them in early January, and you find out that Kylie Cosmetics is getting sued in 2026. When you're preparing those 25 financial statements, you must disclose that because that could affect a decision maker. G is for going concern. This assumes that the business will operate for the foreseeable future. For example, if you work at Kylie Cosmetics, you're going to assume that you can go to work the next Monday and that you're not going to drive there and then suddenly the business is just closed. M stands for materiality. That means focusing on items that are significant enough to make an impact in financial decisions. For example, rounding. Say you're preparing a balance sheet and it needs to be rounded to the nearest whole dollar. For cash, you have $100.03, so you round it to $100. That's not material. M stands for monetary unit. All transactions are recorded in stable units of money, like US dollars or pounds. Financial statements aren't based on bartering goods or inflation adjustments, just straightforward monetary values. And finally, A is for accrual accounting. Revenue is recorded when earned and expenses are recorded when incurred, not necessarily when cash changes hands. For example, if you order leggings from Lululemon in May but pay in June, Lululemon recognizes the sale in May, not in June when you actually gave them the cash. And if you want to learn a little more about accounting basics, consider purchasing my very short ebook off of Amazon.